Hello. In this session, we are going to look at post-trial balance adjustments. These are those adjustments which have to be determined and calculated once the trial balance has been prepared, because the effect of these adjustments still remains outstanding in the trial balance. And then before the completion of financial statements, we must have to complete these post trial balance adjustments. They are of very many types. For example, you can consider depreciation, which has to be done after the trial balance has been created. Then you can consider like the interest on loans. Sometime the interest on loans remains outstanding, which we have to record it. And accruals, prepayments, deferred incomes or revenues, etc., etc. Quite a few. So first of all, you need to understand that these adjustments are those which are to be made after the trial balance has been prepared. Now, as far as these adjustments are concerned, they are based upon an accounting concept which is called as matching principle. Now, what is matching principle? Matching principle simply is this, that the financial statements are prepared for a year time. I mean, they can be prepared for a month, quarter, 6 months, or 1 year, but by law, they have to be prepared at least for once a year at the end of the year, which is the year end. Now, the matching principle is that the income or revenue and expenses of the same financial period must be recorded or recognized within the same financial period. So if there are any expenses or incomes which relate to the current financial period must be recorded. So income of the current financial period and expenses of the current financial period. Okay, and this goes in association with another accounting principle or concept which is called as accruals. Now, accruals are that all financial transactions must be recorded regardless of cash receipt or payment. Whether the business has received cash or paid cash, or whether they haven't received cash or paid cash, but long as the financial impact relates to the current financial period, those transactions must be recorded in the financial period. Okay, so we can start with these post balance trial balance adjustments with accruals, which are quite common in the life of the accounting students. Okay, and sometimes accounting students get confused about how accruals should be dealt with in the financial statements. So first of all, you need to understand that what are accruals. Accruals simply are those expenses. These relate to the expenses. These are the expenses. Okay, some people call them as accrued expenses. Expenses for which the organization has consumed the service but has not yet made the payment for. So they have consumed the service against that expense, but they haven't made the payment yet. The payment is still outstanding. A number of times it happens that the business receives the service, but the payment has to be made in the next financial year, in the next financial period, because a number of times these service contracts are of such nature that the bills or invoices are raised after the financial year has ended. Now think about in your personal life, especially these utility bills. So what I basically has observed over my lifetime, which you might have as well, that you use the electricity for the whole month, and once the month has ended, then the next month starts. And in the very first week or second week, you receive the bill, whether you receive it online or you receive it by post. But the bill of the current month is received in the next month. Now you use the electricity service for this month, but the payment will be made next month because you did not receive the bill, electricity bill, in the current month. So I can say for the January's electricity used, the bill usually comes to the business, to the organization, during the month of February. Okay, month of February. And as the bill comes in the month of February, so it means it remains unpaid at the end of January, even though the electricity was used in January, but the payment will probably be made in the month of February. Again, another example. For example, what happens to the salaries of the staff? Okay, a number of times it happens that staff works for the current month, but their payment may be made on the first of next month or second month or so on. Okay, now as far as the accounting concepts are concerned, at the end of financial period, we must recognize any impact of the transactions in the financial statements, whether we have paid for them or we have not paid for them. If the service has been received, we must have to record them. Now, in order to understand accruals, I can create a little example, and then I will explain the usefulness of something called as a timeline in the accruals topic. Timeline is very, very important. If you understand the timeline, then your life is very much comfortable. So before that, let's have a look at a little example which I'm going to create right as we speak. So for example, for a firm, the financial year end is December 31st. So they close their year on 31st of December when they prepare financial statements, income statement, balance sheet, cash flow statements, and so on, all that nonsense we are aware of. So financial year end is 31st of December. Okay. Here we are talking about electricity. The electricity bills are received every, let's suppose, 7th of the month relating to the previous month. So whatever electricity we use in January, the bill will be received on 7th of February. Whatever electricity we will use on 7th of, in the month of February, the bill will be received on 7th of March. And this keeps on going. Now we know that it keeps on going for the entire year. So for example, the month of January, the bill was, let's suppose, $100. The month of Feb, the bill was, let's suppose, $120. I'm just making up. For the month of March, the bill was, let's suppose, $125. For April, please don't get bored, okay, $130. I'm just making up numbers just to make sure you understand this. Then month of May, it was, let's suppose, 100 again. For month of June, let's suppose 140. For July, based upon variable consumption, sometimes we use more, sometimes we use less. Then August, the bill was 150. For September, the bill was, let's suppose, 120. For November, the bill was 130. and December, the bill was 125. Okay, now you have to understand and appreciate when will we pay the January bill. Yes, you are right. We will receive it on February the 7th. February bill will be received on March the 7th. Okay, and let's assume we pay on the same day. March bill will be received on April the 7th. And this keeps on going all the way every month. Now, last month, when will we receive the bill? Yes, thank you so very much. We will receive on January the 7th, which is going to be the next financial period. Remember, the financial year end is 31st of December. Okay, but the bill will come to us on 7th of January and we will probably pay it on the same day. Now, can I say here that all the bills right from January to November, they would have been paid during the current month, sorry, during the current year, my mistake. So right from January to November, all the bills have been paid in the current financial year. But what about this December bill? When we will pay? Will we pay in the current financial year? No, we will pay this December bill in the month of January, which is the next financial year. So basically what will happen right from January to November, we will record this as debit the electricity bill, electricity expense, let's say. Electricity expense debit, whatever the figures are, you can add them together, okay? And we will credit bank or cash, whichever mode you are using to make the payment. So we will debit electricity expense because you know that all expenses are debited when we incur them. And we will credit the bank or cash. But what about December bill? We haven't made the payment yet. We will make the payment of December bill in the month of January, which is the next financial year. But we have to close our accounts on the 31st of December. So what we will do, as this electricity was consumed in December, so it still is an expense. So it is still an expense for the current financial year, $125. But we haven't made the payment yet. So what will we call it? We can call it electricity payable. Okay. Some people or some books call it accrued electricity. Accrued expense, right? So it doesn't matter what you call it. You can call it electricity payable or you can call it accrued electricity. Okay. So this is how we will recognize. Now, how the impact of this post-trial balance adjustment will be recorded, that in the income statement, you will record electricity expense for 12 months. So the expense, electricity expense of full 12 months will be recorded here, whatever the figure is. Okay, so full 12 months electricity expense will be recorded right from January to December. Even we haven't paid yet, but that's the accrual concept. And what about balance sheet? When we will prepare balance sheet, what will be recorded in the balance sheet? Now remember, from January to December, we have paid electricity for 11 months. Only December is outstanding, unpaid. So December bill was 125. So here we will record in the balance sheet as electricity payable. And what is payable? You know that payable is a liability. Payable is a liability. So as a liability, current liability, to be more precise, because it will be paid in the current financial period within 12 months. So it remains as current liability. So this 125 will be recorded as electricity payable in the balance sheet. So we will continue with accruals, more examples, and so on in the sessions coming along. Thank you.